Good morning, everyone. I just had it on there for a few seconds as I saw more and more people dialing in. So, as I said, good morning, everyone. You're very welcome to the first of a three-part series of webinars aimed at businesses based in Northern Ireland that we will deliver between now and the end of the year. To introduce myself, I'm Shane O'Hanlon and I'm the Funding for Growth Manager with InterTradeIreland. This morning's event sees us kick off Phase 3 of InterTradeIreland's Funding Advisory Service for established SMEs. The aim of these workshops is to assist established SMEs who are looking for new or alternative sources of finance. The programme evolved from research that highlighted that while there was support for startups seeking finance, there was less support available for established businesses, and they tended not to be aware of the full range of funding options available to them. So when we started planning for Phase 3, we envisaged physical workshops right across the island. However, like everyone else, we've had to adapt to new circumstances. Therefore, for the remainder of this year, we will provide these sessions in this format with a focus on the current COVID-19 impacted business and funding landscape. I'm pleased to say that Grant Thornton will continue to work with us to deliver the programme, and it is great that they are able to bring their considerable experience and expertise to the table. Before I hand you over to Andrew Webb from Grant Thornton, I want to bring your attention to two of the primary supports InterTradeIreland are delivering on a daily basis in response to COVID-19 to assist businesses during these challenging times. Firstly, eMerge. eMerge makes a real difference. It provides up to £2,500 fully funded consultancy support to help companies in manufacturing and tradable services improve their online sales and marketing and identify opportunities for e-commerce. Project plans that are coming across our desks on a daily basis include activities such as strategic advice on mail campaigns and website design, a lot of work on search engine optimization, help to set up Google Ads campaigns, advice, guidance and training on best practice with social media. We're also seeing the delivery of reports that outlines the cross-border e-commerce strategy for the brand and the development of a digital content strategy and plan that continues to drive sales, extend brand awareness, and builds on brand loyalty. We've already seen some great success stories, including a company that I can think of that has secured a contract worth nearly £1 million from a contact made via an eMerge supported e-marketing campaign. We've also had a number of examples of manufacturing companies generating direct sales online for the first time. So that's eMerge. I encourage you to take a look at it. It's really helping a lot of businesses on a daily basis. Secondly, emergency business solutions. EBS provides professional advice, fully funded to the value of £2,000 for cross-border companies in manufacturing and tradable services to address key business challenges related to COVID-19. Support is provided for including the following: guidance and direction to government supports and helping in applying where feasible, completion of lending applications for loan supports, guidance and direction with regards to cash flow and the impact on your supply chain. It can help with legal issues, including employment redundancy advice, as well as on contracts and leases. We can help support to help business diversify. We can help with health and safety risk assessments, business risk assessments, and support to allow a rapid repositioning of your business strategy. So I would encourage each of you to visit the COVID-19 section of our website, InterTradeIreland.com, where you will find the eligibility criteria for both emergency business solutions and eMerge. Both have a simple online application form with a quick turnaround. So thank you. As well as thanking Andrew, Neil and Charlie from Grant Thornton, I want to sincerely thank Mark Sturrett from the British Business Bank and Robert Mcculloch from Danske Bank for giving up their time to be with us this morning. It's very much appreciated. In terms of the agenda, you'll see from the agenda on the screen that Andrew's going to follow in a few secs. Neil's then going to speak about the government supports, the loan schemes. He's going to come in again and talk about funding applications. Before and after Neil, we're going to hear from Mark Sturrett from the British Business Bank. Charlie's going to be interviewing him, and thereafter, Charlie's then going to speak to Robert Mcculloch from Danske Bank. I will then come back in for a few secs and talk a little bit further about some of Intertrade Ireland supports before we finish with the all-important question and answer session. So I would encourage you to start thinking about your questions throughout. Put them in the Q&A section, and Charlie will moderate that later. So please get as much out of this morning as you possibly can, and I'll hand you over to Andrew Webb from Grant Thornton, who's going to speak to us about the economic outlook. Thank you.
Thank you, Shane, and good morning, everybody. As Shane said, I have several moments just to give you an overview of where we are in the economy and try to unpick some of the insights as to where we're heading next. So I'll just begin with an economic snapshot, which gives just an overview. And some of this is starting to feel like a bit of ancient history, just given where we've come from in the last 6 months. But I think it is important to note that we were coming from a position of strength in the economy. The labour market was posting record jobs in early part of the year, and unemployment rates were particularly low. Obviously, all of that now, as we know, has gone significantly south and spiraled downwards, and the impacts on the labour market are projected out there over the next year to dip considerably. Reluctant always to put numbers on this at the moment. Some forecasters are trying to do that, and I don't envy them, but I think we're in the realms of unknown but significant dips. There's two potential paths for the economy that are being predicted at the minute, with the OECD proposing a single hit and a double hit, both with equal probability. The double hit would be predicated on a autumn where the COVID pandemic gathers pace again and leads to a more shut down economy, and the reopening that we've been experiencing comes to a shuddering halt. So, as I say, very, very much unknown at the moment. And in a local context, it's been a very deep and damaging decline. And the next slide just shows where we've come from on a monthly basis. This is Fraser Verlander Institute. Have been working with the Department for the Economy just to profile out where we are and where we're heading. And it's stark just how far we've dipped. We've dipped by 28% from peak February through April to what we think was the turning point, as some of the economy then started to reopen in April. We have started to see some increases in economic activity. People are back to work, shops reopening, etc., etc. But the economy remains down still 16% on that February peak, and it's very much a case of how we climb out of that will be determined by as the furlough scheme ends and how many of those jobs come back and how that plays through the economy. And the job retention furlough scheme was absolutely crucial to protecting the jobs that, as I say, we had experienced very strong growth on. The Northern Ireland labour market was in a particular moment of strength, and the furlough scheme has gone significant lengths to protect that. The key sectors there, just to put that in context, where the furlough scheme has played a significant part. If we look at, and this will be no surprise, accommodation and food services, which are shut, and many still are in terms of the wet pubs, 81% of that sector, the jobs in that sector were being protected by the furlough scheme. If we look at the construction sector, 71%, arts, entertainment, 70%. And it's really now, we're at that point of inflection where employers are now expected and have to start contributing to the salaries of furloughed staff, where we're going to potentially see greater dips and some of those furloughed jobs maybe becoming more permanent unemployed. And if we look at the impacts in terms of where we're heading, very much varied across sectors, and how we unpick our way out of lockdown and how we move into reopening. We know then that the hospitality sector, the arts sector, is in that very high risk category, and this is all profiled out by the impacts potentially of social distancing, 2 meters versus 1 meter, etc., and just what that might mean for our employment. So those very high risk sectors, obviously care workers, sales workers, those that are facing off with the public, but at the low end of the risk sector, are at the risk profile. We've got the sectors where we're actually, Northern Ireland and Belfast in particular has been enjoying lots of success recently in the cyber, ICT, financial and business type services. So a mixed bag in terms of where the impacts will be. But as we move through to the next phase of the economy, we have to see the bigger, more holistic picture, and those expected permanent job losses that could potentially come as furlough starts to close, start to impact right across the economy. And this is where then it becomes very difficult to unpick just with any sort of precision at the moment where the economy is heading. Because when we see households who maybe lack confidence or maybe have lost their job, they condense their spending and maybe move to where they can, trying to save and protect as much cash as possible. That then takes money out of the retail sector. There's also reduced taxes being generated through the government sector, and then that has a trickle down impact through how that relates into the business sector. At a macro level, we've seen supply chain disruptions impacting on businesses' ability to supply customers. We've seen businesses obviously being closed and not being able to serve customers, and that's having a vicious circle impact on the performance of the business sector, which then leads into potentially how they delay investments and, do they survival's the key point at the moment, but where they're fortunate enough to survive, do they delay investments, do they protect cash? And all of this plays into where we're headed next as the economy, and the risk then is that if this grips, that there will be a downward spiral. And then in terms of the scale of that potential downward spiral, those that are prepared to stick their heads over the parapet and try and put a number on it, Ulster University are saying just around 10% of a dip this year and coming back. Danske Bank are in a similar space in terms of their latest projections. So it's a significant and downward dip, but the hope and the proposal is that it comes back, but the risks are there that it maybe doesn't come back up as quickly as it came down. Just moving on to the next slide, because it's, I think, within that fairly bleak picture, and I'm conscious that it is a fairly downbeat story that I'm telling this morning, but I would stress that it isn't all about COVID-19, and there are opportunities that we're starting to see come through, and there will be economic growth opportunities within this, believe it or not. And one of the ones that jumps out at us when we're engaging with our client base is that we've really pushed technology to its absolute limits. We did that very early in the process. So many businesses implemented their resilience plans and they're pushing workers home where they could. And that has identified where the fault lines lie in many businesses. And that old trope of we've always done it this way holds no water anymore. And that's potentially going to then see a virtuous cycle of innovation. People had to adapt. They've proven to themselves and their businesses that they can think of new innovative ways to do things. And that should potentially lead to more innovation in terms of processes and products. And we've already had examples of some of our client base building more resilience into their organizations through where they've been able to make an investment in a bit more automation that builds resilience in terms of where their people maybe couldn't be present. They've been able to automate some of those processes, and that's been a theme in the economy that's been bubbling under the surface for a number of years, and we're seeing that accelerate now. Within the where people do their business, do their work, we're seeing a debate starting to emerge as to whether or not there's going to be death of the high street and lots less demand for commercial footprints. That's unclear at the moment where that heads. We're still seeing that discussion play out, because we see a lot of businesses realizing that ideas and collaboration happen where people meet, and the old urbanist views coming through that creative collaboration is where sectors rub up against each other and people get out and see other sectors doing things and learn from that and move on. So the commercial footprint argument is one that I haven't settled on yet, but certainly will play out over time. And we're seeing those discussions had, but I think there's a sense that certainly from a government perspective, there's an urge to get people back into office space. And I think from a productivity point of view, there's certain logic in people being together and being able to collaborate. One of the other key themes that we're seeing coming through as well in terms of where the economy heads next is localism replacing globalism. And that goes back to the disruption in supply chains and how people maybe realized their supply chains were very dissipated across the globe, and that left them a little bit exposed to this type of issue. There's a potential then opportunity for more localism to creep into supply chains, and that could potentially be an opportunity for some of our business base here to expand or diversify to protect themselves and maybe make their own supply chain more resilient. And I'll finish on Brexit. I'll not go into any sort of depth as to where we're heading with Brexit. I'm not entirely sure where we're heading with Brexit, but it's a key issue that hasn't gone away. And there was a sense emerging during COVID that the Brexit issue had maybe taken a back seat. It's very close. It's upon us at the end of this year, and that will play a significant impact on where the economy heads next. So I'll leave it there. In terms of a closing thought, the economy is at a point of inflection. We are coming out of the depths of lockdown, and some confidence is building back in the business community. We're seeing that through the PMIs from the likes of Richard Ramsey and Ulster Bank. But there's a slight falling off in that it's a nervy time for consumers, it's a nervy time for businesses, and it's the likes of government supports and these various schemes that are going to help bridge people's fears through to hopefully recovery. And on that, I'll hand over to my colleague Neil. Thank you.
Thanks, Andrew, and good morning, everybody. I'm going to take just about 5 minutes here just to cover some of the government support schemes, really just for awareness, and I'm sure many of you in your businesses are already taking advantage of some of these schemes and the benefits that they're bringing. So in terms of the support, Shane has obviously outlined the supports that InterTradeIreland have available. They have the potential to be of significant benefit and help to your business. So that's just the website there to find out a bit more about those schemes. But of course, the Q&A, you can ask any questions of Shane as well. In terms of the government schemes, I think one of the difficulties has been keeping track. There are so many schemes coming and going that people have found it quite difficult to actually see what they qualify for, how do I apply. So in terms of a single source that we found quite useful, the NI Business Info website has been quite good source for us as a single point. It's updated daily. It's nicely broken down into different categories, and of course it's NI specific. So if you're seeking a source just to do a check that you're benefiting from everything you should, that's a useful place to start. In terms of the key categories of supports, the grants, the key schemes on the grants are closed. There's one scheme still open until September the 11th for the childcare sector, but other than that, the main grant schemes have closed. Now, it's been well publicised that there's a pot of money that as yet has been unallocated. So that's probably an area where we expect to see more. Potentially for some of the sectors that are harder hit, and potentially if we have a second wave and the sort of second downturn that Andrew outlined, if we had that scenario, that you'd probably see more grant schemes coming on board. In terms of paying employees, again, Andrew, mentioned the furlough scheme or the job retention scheme and the importance of that. Again, that has changed as of 1st of September, so employers now have to pay 10% of the wage plus national insurance and pension. That goes to 20% plus national insurance and pension on the 1st of October, and then that scheme closes at the end of October. Albeit there is also the job retention bonus of 1,000 for all those employees that are brought back between November and January, subject to a few conditions around that. Statutory sick pay, if you have less than 250 employees and employees are off sick because of COVID-19, that is still open to you to benefit from. Tax and rates, under tax, you have the potential for time to pay arrangements with the revenue, which can be negotiated on a case-by-case basis. There was the VAT deferral from Q2 until March 21. and there's the 5% VAT for hospitality and leisure. In terms of rates, there was the 4 months rates holiday, and that was 12 months for certain sectors that were harder hit. And that's probably the second area where we expect to see more, particularly as the furlough scheme comes off and there's pressure on businesses with payroll, etc. Potentially tax is where you're going to see some more support being given by the government. And trading internationally, so the government will guarantee your trade credit insurance, and that's a useful one for anyone who benefits from that product. In terms of the loan schemes then, which will come up quite a bit in today's session, and Mark from the British Business Bank and Robert from Danske will give you much more of an insight into the schemes. I'm really just going to introduce them. So, I mean, the first one is the bounce back loan scheme. That is up to 50,000, subject to a cap of 25% of turnover. It's 100% guaranteed by the government, and essentially it is an automatic approval. You also don't pay any interest fees or any repayments in the first 12 months. So I guess a lot of people have taken advantage of this scheme. Some of them because they need the money, some of them because they thought, well, I may as well have 50 grand as a buffer, which makes sense. So there's been massive uptake in that scheme. I guess, you know, something Mark might touch on is just there's a little bit in the press around, you know, repayment under that scheme and how repayment will work and how the recovery process will work where there isn't repayment. But certainly it's been extremely popular and there's been massive uptake. The CBIL scheme, so Coronavirus Business Interruption Loan Scheme, and the CLBIL scheme, which is for larger businesses, there's been significant uptake there too, but I think that, you know, potentially the role for those loan schemes could be to come. The Coronavirus Business Interruption Loan Scheme is for businesses with up to 45 million turnover. The large scheme is for above 45 million turnover. These come with an 80% guarantee from the government. In the case of CBILs, there's also no interest or fee repayment for the first 12 months. Key criteria there, you obviously have to be UK based. You have to be not in distress at the end of last year. You have to be negatively impacted by coronavirus and have a viable proposal that would otherwise have been approved by your funder were it not for the virus. So those are some of the schemes that have come out in terms of the loan schemes. They're the key criteria. There's another couple of loan schemes there. There's the Future Fund, which is more for equity funded schemes, and that is matched private investment with convertible loans. I think there'll be less of an uptake for that because we have less of those businesses. Also, it needs the matched funding. And you also have the corporate finance facility, which is administered by the Bank of England. And that, again, I don't think we'll have any of those in Northern Ireland. In terms of the CBIL scheme, it does end on the 30th of September, but there's probably an expectation that will be extended. I mean, as the furlough scheme is withdrawn, as tax bills come to be paid, as payroll comes to be paid, I think there's going to be more of a need for some of these loan schemes, both for businesses to access the money and also for banks to have the confidence to advance the money. So expectation is that those will be extended, but maybe that's something Mark can give us a wee bit of an insight into in his session. So I think now we're going to move to a bit of interactive technology. So we're going to use the Menti program just to ask a few questions of the audience and just to garner some views. So if you can go to, on a separate window, go to menti.com and input that code, you will be presented with a number of short questions, which will be multiple choice, and we're just going to see what the results are from the audience. So we're going to give you a little bit of time to go into menti.com, enter the code 8262402, and just feed back into those questions. So we'll just give everybody a bit of time to feed into that and see how the results come out. So I think at this stage we can see a pretty clear trend for the first question. So have you received support via a government COVID-19 loan scheme? You can see there's been quite a bit of uptake in the bounce back loan scheme, as we'd expect. And you're going to see some statistics on that later from Mark. You'll see the scale of the uptake there. CBILS or large CBILS loan, lower at 4% as you expect, but good to see that some people on the call have been able to benefit from those. A little bit of a surprise to see 73% have not taken a loan scheme, particularly given the uptake in bounce back. So, you know, that's interesting. So the second question, so for any who did take a loan scheme, what aspect presented the biggest challenge? So it seems as if providing all of the information and financials was a bit of a challenge and getting approval. That's 29% and 14%, but then there's probably been a mix of other in there, which people have had challenges with. So, you know, maybe some of that will come up in the Q&A and we can feed into that. Paperwork coming through there as a smaller issue, but still 11%. Okay, so you can see the pattern with that one. Application paperwork, bit of an issue. Funder approval, not much of an issue at 8%. Providing all the information of financials seems to be a bigger issue, and the session I'm going to do later on is on funding applications and how you might structure those and what information you might provide. So hopefully that will be of some use. And the next question then. So are you planning to apply for a new or an increased support via government COVID-19 loan scheme? Yeah, so some interesting trends developing there. Small amount to apply for a bounce back loan scheme. I'd encourage you to do that. Now it's a relatively simple process. So for those in that category, it's something I'd encourage you to go ahead and do as of now. CBILS or a large CBILS loan, again, relatively small percent, but it's worth engaging with your bank to get that discussion going. No, I don't need debt, roughly a fifth of the audience, which is good to see. And potentially that's some of those businesses that are positively impacted. Really interesting to see over 60% don't want to take on debt. Perfectly understandable, particularly given the last financial crisis, which is fresh in a lot of people's minds. But again, you know, we are in exceptional circumstances, and you know, it's worth thinking about, do you need that support, and is that something that you can take on and manage comfortably? And if it is, it's something you might want to consider. And then the final question, if yes, so if you are seeking to apply, what aspect are you most concerned with? Probably would expect to see a similar pattern to question 2. Yeah, so same sort of things coming up. The paperwork, providing the information and financials, and getting the credit approval. Now, ultimately, those are linked. If you have a clear and well-structured application that addresses all the issues and you provide the information, that is going to significantly increase your chances of getting the funder approval. So some interesting trends coming out of that. I'm going to hand over now to Charlie and Mark from the British Business Bank to have a chat on what has come out of that and really generally around some of the government loan schemes.
Thank you very much, Neil. That was really interesting, actually, getting the feedback from the audience. So my name is Charlie Curran. I head up the corporate finance team for Grant Thornton in Belfast. And I suppose since the March of this year, we've been heavily involved with advising our SME clients in relation to trying to navigate through the COVID-19 crisis. And I suppose a key part of our role as well has been to engage at a policy level as well with organisations like the British Business Bank in relation to trying to ensure that the appropriate funding is provided to SMEs and certainly getting any of the tweaks out of any of the operational elements of that. So I'm delighted this morning to welcome Mark Sterrett from a British Business Bank. Mark is a UK director covering Northern Ireland, Scotland and Wales. And as Neil has said, the British Business Bank, through its various supports, effectively has been a key player, we believe, in helping a number of businesses in Northern Ireland through COVID-19 to date. And I suppose we see as key going forward as well. So a very warm welcome to you, Neil. Sorry, Mark.
Sorry, thank you very much. Thank you for the invite to come along this morning, and hello to everybody else as well.
Yeah. Well, Mark, would it be useful just maybe for the audience to introduce British Business Bank and I suppose give an indication of what you do and maybe what you don't do, firstly, and then I think it'd be really, really useful to bring us up to speed in relation to where Northern Ireland SMEs sit in relation to the usage of the various funding schemes in Northern Ireland.
Yeah, no problem. Yeah, I think you're right. Suppose I'll just take a very short time just to briefly introduce the British Business Bank as an organisation. So it's probably come into the common parlance more in the last 4 to 5 months throughout coronavirus than it had done in the previous 5 years. But as a bank, we've been in existence since 2014. And probably the first thing to point out is that although bank is in our name, we're not a bank in the traditional sense you might expect in terms of previous experience. So we don't hold a banking license. And what we are is a economic development bank that is owned by the UK government. And our purpose is on behalf of the UK government to make access to finance easier and more efficient for businesses across the whole of the UK to help them prosper and grow. So in broad terms, the British government trusts us with their funds, taxpayer funds, and we then go out and we recruit different delivery partners that operate across the whole of the UK, and it might be in any number of different aspects of finance, and it could be equity or debt or angel finance or all sorts of different ones. And we bring those delivery partners on our behalf, and they operate in the marketplace and make those funds flow and make finance work better. That's on the supply side. Where I come in is the bank also has a crucial role on the demand side. What we mean by that really is, I suppose, providing the education and the tools and the skills and the awareness of the types of finance that might exist, the types of providers, and what might suit a business depending upon if it's in the early stage startup, if it's in the rapid stage growth, or more mature type business. So we work very closely with other stakeholders. As you say, I'm director for Northern Ireland, Scotland and Wales as equivalent across England. And we work closely with the stakeholders across all of that to try and make sure that the right balance of demand side education and awareness is matched up with the supply side. So a business that needs finance both knows what would suit and then should have access to the type of finance that might suit their business. And I suppose to a large extent within that context of lots of different types of funds and things that might work for different businesses, the reality has been for the last number of months, to some extent, the only show in town has been the COVID loan schemes or debt schemes that have been in place, launched in late March for STEBLs, the coronavirus loan, business interruption loan scheme, and then the bounce back loan scheme came on stream some weeks after that. Overall, they have deployed significant amount of debt essentially into the UK economy. So since those schemes were launched, there's been over 50 billion have been deployed across the whole of the UK on both those schemes. And I think the crucial thing to point out at this stage, and probably as we go on as well, is that they are debt schemes. So they are facilities that will be expected to be repaid by the SME. So they might be appropriate for some, but in some cases also they might not be. And it's interesting just picking up on some of the replies on the survey there in terms of the potential sentiment around the preference to avoid potentially more debt, and that's, as Neil did reference, quite understandable in some cases. When we look at the bounce back loan scheme, you'll see here the stats have been released for Northern Ireland in particular. That's coming up on 27,000 loans that were approved. These stats are correct as at sort of mid-August, so they're still thereabouts in terms of accuracy. They're fairly up to date, and the value of that is about 860 million. For CBILS, it's somewhat less, so it's still sitting sub 1,000 facilities approved and about 260 million, and that's about 1.1 across the whole of Northern Ireland. What that means for the context in terms of our share of SMEs within Northern Ireland is that this is broadly in line. Northern Ireland has about 2% of all SMEs across the whole of the UK, and this represents, broadly within rounding parameters, around 2% of what's been deployed, both facility and volume-wise. So it's there or thereabouts essentially on that side. The other, I suppose, the third leg in the tripod of supports that came on stream was the Future Fund. Some stakeholder feedback from the ecosystems came in to say that when COVID first hit, the debt schemes were launched, and they provided a bit of relief in terms of those businesses that needed that support to help them to maintain their viability going forward. But also there were a significant number of businesses who were perhaps in pre-revenue or certainly pre-profit and needed also some sort of support. And this is the Future Fund and where it steps into that. You'll see from this that Northern Ireland has had 5 facilities approved. There's a particular set of criteria for this. By its very nature, it's going to apply to many fewer companies than would otherwise be the case, for example, under CBILS or BBILS, which are more for established SMEs. So again, there's 5% there. It's 0.85 and 0.85 for the national total, so it's in line on that side, but it's lower than the share of SMEs overall. So these, you would think, are potentially looking at the high growth potential, but pre-revenue, so really early stage. And there's some parameters around it that made it perhaps less accessible. Potentially things such as EIS and SAS investors were not eligible for it, and that had a certain cap on who could come on stream. But it remains open. There has been good demand across the whole of the UK, and like I say, a number of businesses locally have availed of that.
And Mark, just as a follow-up on that, I mean, obviously it is very interesting to see how Northern Ireland sits against the rest of the UK. So obviously in relation to the Future Fund, it looks like it is behind. And again, I know from conversations that there was sort of various bits of teething problems. Is there a view of that there's something needs to be a tweaking around that Future Fund to maybe make it more applicable or usable for NI businesses, or what's the view there?
Yeah, as you say, there was a fair degree of feedback on it, and that came from businesses based in Northern Ireland, and I can say the same for certainly Scotland and Wales, and to some extent across England as well. The reality is it's an equity type product, so there has been a long-standing imbalance in terms of equity deployment across the UK, and there's the golden triangle of Cambridge, Oxford and London, which soaks up far more than its fair share in terms of the equity interventions given the number of high growth business, and that has been reflected again within the Future Fund. So they have taken up a significant proportion of that because I suppose there are more businesses and more people. They can say the feedback for once you went beyond that is that there were certain restrictions that made it less appealing. What I would say is I don't envisage any significant change to the Future Fund parameters and the rules that govern it at the minute. But I think the feedback and the lobbying from stakeholders and ecosystems across the UK would say that the product itself has been well received in terms of it was a useful intervention, and it would appear to have the baseline for something that could be used as a future product, perhaps not exactly in line with the Future Fund, but certainly I think that's something that could be looked at, and the tweaks could be made on a potential successor if that became appropriate in due course.
Mm-hmm. And Mark, obviously, any immediate reactions to the Menti poll, and I suppose any maybe surprises in some of the things that's coming through there?
Yeah, I was making notes as they're coming through, and surprises probably not necessarily, because I think there has been some aversion to taking on more debt throughout this, as the sort of the white heat of the immediate March and April passed by, and businesses realised that there were other supports available to help. I think the important bit to note is that the CBILS and the VBILS schemes both are debt-based schemes, and it's essentially one plank of support that's there. So that, as Andrew alluded to before, there's a job retention scheme and there are many other schemes in terms of rates relief and grants and bits and pieces. And I think it's important for any business looking at what support's available to make sure that they look across the full spectrum and avail of all the particular supports that are there. So I can fully understand business owners at the minute sitting back and being a bit wary of potentially taking on more debt, just given the wider economic uncertainty. So I think I can understand that. I think as well, the market, the demand for it was huge when it first came in, but the feedback has been and the uptake has been that it's been fairly well served. So we're probably not anticipating a huge uptake as it approaches the deadline. So CBILS closes at the end of September, 30th of September, and the profile of applications that came through over the lifespan from March through to now has been a significant front end demand and drawdowns, and that has fairly stably tailed off over that period. And so in terms of feedback, not particularly. I think the scheme evolved a bit as well in terms of initially there was more need for some paperwork and more need for information. Again, but that feedback into the system meant that the rules and parameters around that could change and be diluted slightly to make it more accessible for those that needed it.
I suppose one of the ones, Mark, and looking forward effectively, was that one in relation to the question of do you need debt funding? That was actually low, but there was do you not want to take on debt? So that maybe again, maybe I can pick it up later on as well. But that whole issue of actually how SMEs are funded and that sort of debt equity and I suppose use of alternative funders, which I know we're following on later webinars. Mark, can I hit you with a few kind of quick questions? One that you started talking about here, this idea of potentially the cliff edge of these government supports, these ending at the end of September. What is the view in relation to the potential of extension, or and if extension, is there any potential for any changes to the structure of those loans?
Well, at the minute, certainly for CBILS, the timeline is that it is scheduled to close at the 30th of September, and that remains the intention. So I'm not aware of any plans or otherwise to change that date. So any business that wants to avail of it needs to get their application into one of the accredited lenders by that stage. There's a short window beyond that where they can work through the paperwork and get the funds drawn down, but certainly to get the application in at that stage. Absolutely, there's the wariness and the potential for, and the phrase is that the cliff edge, if the schemes run off at the same time, and then potentially the repayment will commence on some of these. So for the first year on the CBILS, the government was covering the interest and the fees attaching to that. So it was an attractive proposition in terms of cash flow. That is going to run off at some point, and that's a stress before they are debt-based facilities. I think that's beyond the British Business Bank. We don't design it. We facilitate and run that on the government's behalf, but the government are acutely aware of that, and there's plenty of press coverage. I know some industry bodies such as City UK have talked about this and what might happen come March next year. So certainly government are aware of the implications for that. I think the big thing for that is any business that has that debt and has a horizon on repayments coming on stream is to take good advice, is to plan for it, is to approach the lender and see what's appropriate, and be aware, as I say, of the other types of funding options that might supplement and complement the debt profile that's there.
And Mark, I think just maybe as a sort of a last question at this stage, but I mean the other key question coming through is almost what next? And you'll be aware, as assuming a lot of your audience as well, is that actually the stress point actually happens when businesses then start back on that growth journey. So again, I assume that's on the agenda in relation to BBB, etc. And is there any thoughts, anything that you can share with us at this stage?
Yeah, well, look, the CBILS scheme came online in March, and at that time it essentially replaced the Enterprise Finance Guarantee Scheme, which was suspended and remains suspended until CBILS comes to an end. That's not to say that all of our interventions were stopped. So throughout that period of the last 5 months, the bank has launched a number of other funds that are aimed at the growth side of SMEs. So those that are still continuing, because the reality is, whereas a lot have been impacted negatively, a significant number also have identified opportunities and are continuing to grow. So we have launched a number of funds, and you can find those on our website. And the majority of those are keen and active to do deals in Northern Ireland. So it's a matter of really engaging the networks and building the ecosystem to make access to those. beyond foreseeables, yes, the bank in conjunction with government and stakeholders looking at what is the best type of successor to that, so it's not simply withdrawn and there's no support there. So very much keen to get input on that from stakeholders, and we are looking at what might come online to replace that.
And again, just from the audience, I would reiterate Mark's point that BBB are very interested in feedback effectively. So certainly things that can help to redesign and get the right type of solutions is vital. Just from the audience point of view, there is an opportunity to ask questions. Mark will be on the Q&A session, so please filter through those Q&A. This is a live, this has been recorded effectively, so again, just for people to be aware of that. So thanks for now, Mark, and maybe if I hand over to Neil here, who will start talking through the sort of the practical elements around the funding application. Again, being aware that came up as a very hot issue on the Menti poll as well. So hand over to you, Neil.
Thanks, Charlie. Yeah, so I mean that has come through clearly in the Menti program around structuring applications, what information to provide, and what I'm going to do over the next sort of 10 minutes is try and outline a broad structure that can be applied by most businesses in the current environment. So I mean, going back to basics in terms of lending, a lender will look at three key elements, and this is lending in its most basic form. So who is the borrower or the management? Is this someone who will repay? Have we a credible borrower? Repayment capacity. Can this borrower repay the money? And security. What happens if they don't? So that in its simplest terms, that is lending. Will they repay? Can they repay? And what happens if they don't? Now, applications internally within banks and other funders will then typically cover a number of areas. So, background to the business, what is the borrowing request? What are the projections of the business? Do those projections show that the debt can be repaid? Where are the risks? And based on those risks, how should we price this? What security do we need, and what conditions do we need to put around it? So that's your basic process within any bank or lender, and what they will consider in terms of a request for funds. Now, in normal times, that is one story, and that is an evolution of a business. The business will have a track record. It has progressed to where it is today, and it is flowing down a certain track, and projections will go with that. I guess where the impact of COVID-19 is that you almost need to tell three stories to a lender at the minute. That is, what was my steady state business pre-COVID-19? How have I been impacted, and how am I managing my way through this? And what does my business look like post-COVID-19? Is it what my old business was? Is it my old business with some benefits potentially? Is it my old business, but it's going to be reduced in some form, or it's going to be impacted in some form for the long term going forward? And what does that mean financially? So in terms of then an application structure, I think you could put something quite simple: your business pre-COVID-19, during, and after. Now, before you would engage with your lender, and pull an application together, I think it's useful to chat with your lender, understand their process, understand what information they're going to need. And if your lender, if you're known to your lender, and they know your business well, or you're not asking for a significant amount of money, that amount of information will be less. Use information that you have readily available. Understand what can you do with your existing debt, what new debt are you seeking to take on, and what is your request. And as you go through this, I mean, try and put yourself in the shoes of the bank and understand, where will the bank focus their attentions? What issues will the bank see? What risks will the bank see? And how can I give the bank confidence that I'm mitigating those risks? So looking at this first section of your business overview pre-COVID-19. So in each of these three sections, there's going to be 3 points. So explain your position, confirm the key points, and provide the information. So in this first section, pre-COVID-19, what are you going to want to include? You're going to want to explain basically what your business does. So pre-COVID-19, what is your business? What does your business do? What is the financial performance of your business? You then want to confirm the key points. So key points, my business was cash generative, profitable, it's a good business, it can borrow and it can repay. And if you have an existing debt, it's worth pointing out that you are repaying that and you're within all of your various conditions. And then the supporting information for your pre-COVID-19 section is going to be your management accounts, ideally up to February 20 when the world changed, and your statutory accounts. So that's your first story. Is there's my business is pre-COVID-19, it's cash generative, and there's the information to support that. Looking then at during COVID-19. So what is the story you need to tell any lender considering advancing funds? Again, under those three headings, so explain your position. So how have you been impacted? So during COVID-19, I've been impacted in the following ways. So it is a supply chain, operations, customers, cash flow, finances. Explain how you have been impacted. The lender will then want to know certain things. One of the things the lender will want to know, and Mark touched on it there, is that the business is doing all of the right things and is utilizing all of the available supports. And that's something you're going to want to point out to a potential lender. And then you're going to want to be clear on what your request is. So are you requesting forbearance with your existing debt, or are you requesting new debt? And if so, are you requesting that under a CBILS loan? And the supporting information for that is a short-term cash flow. So showing how your cash flow is managing through this middle period, this during COVID-19 period. And just in terms of cash flow, I just want to touch on that just in a wee bit more detail. So obviously cash is cash is king, as everybody's saying at the minute, for want of a phrase, but it's certainly important to manage your cash flow at the minute. And short-term cash flow forecasting is extremely important for any business. Now, what is that? Well, again, things work best when they're kept simple. So it's a simple opening cash position, what's incoming, what's outgoing, what's my closing cash position, and how does that sit relative to any working capital facilities I have? So that's what the lender is going to want to see in that middle section. A few tips around that. I mean, varies by business, but normally the period there is going to be sort of 3 to 6 months. Depends on the business. Could be shorter. You want to build in some flexibility to your short-term cash flow forecast that you're going to give to the bank or the lender, and you want to show scenarios. So what if? So what if a certain contract doesn't happen? What if a certain payment doesn't come in? You want to include your government supports, and take care with timing there. So show if you're benefiting from a time to pay arrangement or a furlough scheme, but also obviously show those payments coming online, when the tax payments need to be made, when does payroll come back online. So be very clear on that. Include automatic payments, so your direct debits and standing orders, you should be actively managing those to make sure that nothing's coming out that shouldn't. And also your cash flow forecast should show you coming through and how you emerge out of the crisis. That's important, obviously, for a lender to see that this is a recovery plan and that you're coming out into a future business that is sustainable. And the other thing is just assign a central owner to that. So it's particularly important to manage cash at the minute, and somebody owning and having responsibility for that cash flow forecast is important. So they're the first two sections. So what does your business look like pre-COVID? How are you managing through COVID? And then the third section is what your business looks like post-COVID. So again, under the three headings, just to keep a simple structure to it, explain your position. So what is your recovery plan? What is your future business plan? What does that look like? Explain that to the lender so they can understand. Confirm the key points. So there may be obvious impacts on your business, and they may be positive or they may be negative, but acknowledge those points, acknowledge those risks, tell the lender how you're mitigating those risks, and give the lender confidence that you're addressing the issues and that they have the confidence to lend. And in terms of the supporting information there, you're going to be getting a 3-year loan, a 5-year loan. So whilst it is very difficult to project forward, at a very high level, try and project where your business is going to be over 3 to 5 years. And really what you're trying to show there is your operating profit what free cash flow comes out of that operating profit after tax and capex and any working capital movements, and essentially show the lender that you can service the debt. So that you have free cash flows of, let's say, 150 grand a year, your debt's 100 grand a year. You want to give the bank confidence that that is the position that they can comfortably service the debt. So that's really just a sort of a very broad structure that you could apply to any lending application, telling those three stories. And Charlie and Robert from Danske are now going to have a chat. I'm going to introduce them. So, you know, Robert will certainly have even more insights from the bank side of things. So over to you.
Thanks very much, Neil. That was, again, really interesting and hopefully really useful to the audience here today, given, I suppose, what was coming through on the Menti poll, particularly in relation to one of the issues being the providing of relevant financial information to the funders. So thanks for that. So I suppose now it's time, Neil and his client having produced the application, now it's time to step across the table to the funder and get the funder's perspective. So I'm delighted to have Robert Mcculloch of Danske Bank in Belfast join us this morning. Robert is the head of the business sector engagement team at Danske, and certainly a number of you would be familiar with Robert for his many webinar attendances, certainly in the month of March. So there's a lot of water has gone under the bridge, Robert, since I suppose we were first engaged in some of these things in the late spring. And Robert, from the audience point of view, we're keen here to very much have that as a practical series on this session, and we're very, very keen to understand some of those real life case studies that you have been experiencing at Danske Bank. And certainly, I think a common issue is really to try and understand like where the bank is now and where it's going to be in the future. So really keen to hear your insights into that. So I mean, Robert, from our point of view, and so was a number of our peers, Danske certainly would have seemed to have been the first bank, I suppose, out of the blocks in the promotion of the various loan schemes, and certainly that seems to be coming through on the number of approvals. Are you happy to share with the audience just where Danske is at the minute in relation to that?
Yes, of course, Charlie, and good morning, everybody, and thanks to InterTrade for the opportunity to come on your webinar this morning. Yeah, look, this has been quite a journey for us all over the last 6 months, and you're right, we tried to get out of the blocks early. It was very clear the intentions of the Exchequer and the government, and we were acutely aware of our responsibility as one of the main banks in Northern Ireland to try and pump liquidity into the system. And we tried to keep things as simple as possible. And, you know, whenever you ask, and Neil has covered really well what a bank will typically ask for. So the difficulty for many businesses was trying to understand what their cash flow was going to be like over a very short period of time. And we tried to focus on what they expected their 6-week cash flow to be and maybe their 6-month cash flow, and to work on our best endeavors to try and get at least something to the bank. But in terms of where we got to and where we are now, I think some of the information, and Mark can confirm this, we got some of the detail of the key information in terms of CBILS through at 4 o'clock in the morning of the day that it went live. So we had to work really quickly. We pivoted key staff into different positions to try and look after the scheme and get it operationalized. And we're sitting at the moment with probably about 50% of the CBIL total. So CBIL approvals at the moment sitting about 120 million. And B-bills is 230 million. So those are kind of in keeping with the stats that Mark presented there. So it's probably 50% of C-bills, 27% of B-bills. So massive upturn in B-bills whenever they actually come line. But it doesn't probably cover the full story. You know, there's a lot of, and the other banks would be the same, where there's been a lot of lending outside of the government-backed schemes. We've done a lot of that ourselves. There's been lots of payment holidays. I think, you know, we have probably had something like 60 million out on payment holidays, and you can see some of that theme coming through, Charlie, where businesses don't want to take on extra debt, so they'll try and avail of payment holidays. And, you know, in reality, from what I have seen, a lot of them didn't actually need those payment holidays, but it was better to be in the safe side. So, we've seen a lot at the moment, and as a lot of those payment holidays have actually come to an end. Some have taken for 3 months, some have taken for 6 months. A lot of them are going back onto full scheduled repayments again. So, those that can't, then we're working with them and probably give them a little bit longer. But yeah, it's worked really well. And there was a few wrinkles at the start, but I think given the complexities and operating such a scheme in the environment that we had, a public health issue as we had, I think it's all came together really well, and I think it shows what can be done whenever the Exchequer and the banking industry and the various bodies around us are all in step and trying to keep liquidity in the system.
Okay, no, thanks for that, Robert. And I mean, are Danske Bank envisaging an influx of applications this month, given the deadline end of September?
Yeah, we're absolutely seeing that at the moment, Charlie. So, you're looking at November, early November, 4th of November for B-bills, the bounce back loans. And as Mark has talked about and the others as well, you're looking at the end of September for C-bills. And the trend was a lot early on, probably not that many at the very start. Then it geared up and there was lots coming through. That trend has petered off over the summer. But now we can see businesses are actually going down the C-bill route again. They're conscious of the end date. What we would see is a lot of businesses were looking at cash flow support at the start of and a lot of it was to cover stock. But it's now moving very much towards guys are looking at investing in the business as well, and they're going down that route. So yeah, we do see an upsurge in it at the moment.
And again, I suppose that anecdotally, that's what we would again see. And I suppose a number of the conversations that we had in the early days, there was a bit of, well, we don't know whether we'll need it or not, and we're not kind of sure where the normality of the business might land. So again, I think we would envisage those things with the deadline coming up, that we would see an uptick on that application process as well. So there'll be a push through, obviously, to try and get these things through the banking system.
Yeah.
Robert, just from the audience point of view, I mean, you've obviously been very, very successful in getting a number of the loans through. Can you give us from a kind of a couple of case studies, obviously anonymized, in relation to where arguably maybe on the first bit it maybe, or certainly the process or whatever needed, or the story needed a bit of a tweak to try and get through? Can you give some sense of where some of those pinch points were in your application processes?
Yeah, Neil has covered really well, what an ideal process is for the bank. But early on, we were working in a fog, really, both the banks and the businesses, and it was difficult to get key information together. So we were basing a lot of our assumptions around the track record of the business. So if you had a good business, a good viable business pre-COVID, then the chances are that you were probably going to have at least a reasonable hope that the business would emerge at some stage. And yeah, in some cases it'll be dented, other cases it will emerge stronger. So it was a best endeavours basis in terms of getting key information together. And I suppose the key information, as Neil has pointed out to us, is the cash and the cash generation of the business, because ultimately that's going to repay the loan. So we went out to press with a number of them. It was in the media. Most of those cases were stock finance. So if you think about it, businesses that had received a large shipment of stock in with payment terms on those that had to be paid within 2 to 3 months, they were sitting with no turnover, no opportunity to turn that stock into cash. So they obviously needed finance. So a lot of those deals that were put together earlier on were to cover stock. I suppose the key area where there would have been a bit of toing and froing in terms of just looking at the cash flow and trying to understand that the cash would be there whenever it would needed to be to repay the debt was just in the sensitization. So how much do you sensitize that? There's probably no exact number you could put through it. So it was a case of getting what seemed realistic to both the bank and the business. So could it be, is 20% sensitization realistic? You're working on the basis, yeah, look, if we're going to get opened by the summertime, that's realistic. If we're not going to get open for a longer period of time, maybe that's that's not prudent enough. So most of those discussions were around the prudence of the sensitization that was deployed on the projections.
And I assume, Robert, then for those companies that have drawn down, then that management information, letting the bank know where they are, I suppose, against their projection is going to be absolutely critical over the next period of time.
It's a key, and most of these businesses that we have worked with, you worked on the basis that you got the most up-to-date information that was available. Then you put together projections on a best endeavours basis. As we're working our way through it, we are starting to see the re-emergence of businesses, and probably the detail that's required with some of those, can be better put together. There's probably some key fundamental factors in those figures that are, you can see on a day-to-day basis. Are they open a short period of time? Is the hours reduced? Are they back up to full speed? What's the market look like in front of them? We can put some more better assumptions in around those at the moment.
Okay, and Robert, then I suppose looking forward to here, I mean, is it the sense within Danske and I suppose around the square in relation to is credit policies tightening? Is there prospect of rates increasing, etc., that is going to impact businesses that are looking for loans going forward, whether it's government-backed loans or non-government-backed loans? What's the view?
Yeah, well, I can understand that, Charlie. It's a fair question. Actually, Andrew touched it earlier on. Most of the banks, including ourselves, have witnessed, and it's not necessarily maybe a good thing, a surge in their deposits. So we've witnessed, a significant surge in corporate deposits and retail deposits within the bank, which actually isn't that good, because obviously that money's going into the bank, it's not been spent, and it's a consumer-led economy, so it has implications, as Andrew touched on. But in terms of debt, fundamentally, if there's a good sustainable business there, generally it will be supported. Now, that you got to think of the backdrop here in terms of most of the risk metrics. In terms of a lot of business is in the red zone. So, there's questions about maintenance of turnover, supply chains, consumer trends, and all this with a backdrop of public health crisis. And, all of this has to be taken on board with in terms of government advice that's available. So, you're probably going to be put through the ringer, so to speak, in terms of getting a better understanding of what you expect the business to look at. There's sort of some more key questions will come at you, but I think fundamentally, if there's been a good business pre-COVID, then it will get supported. A few more questions around it, but I think Neil talked about the stories you have to give to the bank. So it's the pre-COVID story, during COVID story, and the emerging COVID story. If you can piece that together, I think fundamentally good businesses will continue to be supported.
Mm-hmm. And I think, I mean, as I said to the audience earlier, this is a series of webinars, and certainly as a corporate finance practitioner, I think it's going to be quite interesting just to see how the funding for SMEs evolves over the next period of time. And certainly I know in the next webinar we are then looking at other alternative funders, which again have maybe working alongside banks to complete the funding package. So Robert, for now, thank you very much for that. We are getting in a number of questions for the Q&A session later. So if you have things that are there generic, then please add those onto the Q&A session, and we'll pick them up after Shane's session. So hand back to Shane again.
Okay, thank you.
Thanks, Charlie. So whilst I'm just going to take a couple of minutes whilst Charlie, Mark, Robert and Neil compose themselves for what I feel is an all-important Q&A session, just to briefly outline some of the programmes and supports that InterTrade Ireland have to offer. And it was reassuring to hear Andrew speak earlier. Whilst, of course, there's an element of doom and gloom in terms of GDP and the state of the economy, he did close by talking about some of the opportunities and some of the things that we as a Northern Ireland economy need to do. And it was reassuring that he talked about innovation, he talked about Brexit, he talked about supply chains, because many of the programmes and the supports that InterTrade Ireland have to offer, focus on these things and help businesses with these things. So just to very quickly go through each of the headings on the slide. Brexit, Our dedicated Brexit Advisory service will keep you informed as we transition to a new trading relationship, and we continue to offer a range of support and advice to cross-border traders. In terms of sales growth, through Acumen, InterTrade Ireland can assist you to source and fund the right people to help increase your cross-border sales. Through Elevate, we can help you identify cross-border markets, customers, and win new business. On the all-important innovation side of things, we have a number of support structures in place for business innovation and growth, including challenge, fusion, and impact programs. We also assist businesses via our All-Island Innovation Programme, Horizon 2020, and Co-Innovate. With all these things, I would ask you to look at our website, intertradeireland.com. On the fundraising side of things, so in addition to the work that we carry out to assist established SMEs, we support businesses along their, generally startup businesses, along their equity fundraising journey. We organise the very well-established Seedcorn competition, deliver an annual venture capital conference, and provide the services of our lead equity advisor. On the tendering side of things, public sector tendering can be a minefield for businesses unless you know how to manage proposals and the formal tendering process. Through Go to Tender and the workshops, events, and advice that we offer, InterTrade Ireland can help. In terms of business insights, InterTrade Ireland has built up an in-depth knowledge of the cross-border market over the past 20 years. Through research, collaboration, and case studies, we're in a strong position to provide valuable intelligence on all-island opportunities, regulation, market trends to both policymakers and business. This should help them make informed decisions and help with their strategic thinking. So this is the last that you will hear from me this morning. So I really just, before I hand you back to Charlie to moderate the Q&A, I just want to emphasize a couple of quick things. Please look at our website. Please look at all the supports we have to offer. Those that I've just outlined there very briefly, and those that I talked about in a little bit more detail at the outset, Emergency Business Solutions and eMerge. I also want to bring to your attention the fact that each year, a small number of companies that attend these funding advisory service workshops, historically in person, now online, will get the opportunity to meet with Grant Thornton on a one-to-one basis. The objective of these being to improve the capacity of participants to raise finance to enable their business to grow. So we'll send you out details tomorrow, this afternoon or tomorrow, with the link for that application process. So I'd encourage you again to look at that. And finally, before I hand you back, I just want to thank you guys for attending this morning. I want to thank our contributors, particularly Robert and Mark. I think you'll agree that they added real value this morning. So I'll hand you back to Charlie.
Thanks very much, Shane. And yeah, we've got a few questions here to deal with. So maybe if people will try and keep their answers short, and that'll be helpful. First one, Mark, to yourself. Are you seeing evidence that the COVID loans have to date been largely deployed as a substitute for more expensive forms of debt and not being drawn down in spending yet?
Yeah, I think anecdotally we're possibly seeing that. And I think what we are seeing, well, I can back it up with some stats. So the Bank of England released the bank lending stats recently for month of July, and that's shown that repayments fell in comparison to June. So possibly seeing that, yes, it was used more in May and June for that reason. And anecdotally we are hearing examples of that. So it's possibly the case. Again, I think the point to emphasize here is that both those are debt-based products. So at the point they're taken down, they become repayable at some point. So it's incumbent upon advisors, banks, and businesses all to be clear about the reason they're taking it on, and it's viable for them in terms of the repayment profile.
Okay, one for you, Shane. I assume that an NI-based registered charity and limited company can avail of InterTrade Ireland funds, funding support that you mentioned?
Our supports are generally aimed at SMEs who are engaged in cross-border trading, manufacturing, tradable services, that type of thing. So whilst we aim to help as many businesses as possible, it can be difficult on the, the not-for-profit, the charitable side of things. So typically no would be the honest answer. But as I say, we look at everything on a case-by-case basis.
Okay. Robert, my core business has been affected by Corona. but thankfully not too bad, around 10 to 15%. I'm planning to build a property investment, not directly linked to the core business, although still part of the same company. Can I apply for a CBILS loan here for my project to avail of the better terms than from the bank?
Yeah, I suppose the key thing is to understand just the association with it all, and yes, it can be. So quite happy enough to take that offline to discuss further.
Okay. Mark, just in relation to someone's asking about the specific deadlines in relation to the loan schemes, in relation to, is it when applications are made or when funds are drawn down, etc. Could you maybe highlight, comment on that, please?
Yeah, so for the schemes, the application has to be submitted by that stage. The funds don't need to be drawn down by that deadline, but they have to be in and recorded and acknowledged by the lender. There is a follow-on deadline for funds to be actually drawn down, but that you discuss that with the lender directly at the point your application is proceeding. Okay.
So Neil, not forgetting about you, given the uncertainty in the market, how can I produce credible projections? Discuss.
Yeah, as I said, it's very difficult to look 3 to 5 days ahead, never mind three to 5 years. So I think all you can do is you can look at what your steady state business was pre-COVID. Consider what the impacts are likely to be on your business, and project forward on that basis. So if you largely think that your steady state business will come out of COVID and largely get back to normal, your projections should be, as they would have been, that business will continue to hopefully grow as it would have done. If there are clear positive or negative impacts, you would have to factor those in and project forward on that basis. And again, Robert touched on it. You know, the bank will look at certain sensitivities. I always think it's useful to be on the front foot on that. So you may wish to project, and you may wish to look at your own sensitivities or your own what-if scenarios and put those forward. But yeah, listen, it's very difficult. But you just have to use the information that you have available to you and the obvious impacts that COVID's going to have. So it's your last 12 months steady state business, and how is that going to change going forward?
Okay, thank you. It's always asked anyone, what rates are banks charging for government-backed loans? Robert?
Sorry, I was on mute there. The B-bills or the bounce back loans is the 2.5%. There was some discussions at the very start of whenever we embarked upon the C-bill journey, and from what I have seen and evidence within our own places, that no one's been charged, as far as I'm aware, anything actually than what they have been paying. So the rates are fairly much in line with what they are being charged with their current bank facilities.
And again, that'll be consistent with what we're seeing across the board from banks, Robert. Another one, Robert, looking forward, are banks expecting higher levels of distress in 2021, and how will they deal with that?
Yeah, that's a great question, and the answer is yes, unfortunately, because if you think about it, there's lots of moratoriums in place at the moment, and as those peter out, and businesses are having to pay back, and as Mark has alluded to, these are debt products, so they will ultimately have to be repaid. We do envisage some of that. So look, the story is the same as it's always been with the banks. They will work with the client to try and get the best solution. There's no point in burying your head in the sand. What I would advise is that if you do see that there's a problem merging, then talk to your professional advisors and talk to your bank very early on, so as you can look at different ways of addressing it. And you know, that may be getting rid of some non-core assets, or it may be been putting a different structure in place, but act early, because the thing that I've seen over a long period of time in the bank is that, you know, people try to put it off and try to bury their head in the sand, and it really doesn't solve it. So if you think it's going to be a problem, act early.
Okay, and just conscious of time here, guys, but I'll take maybe one more question. Say that any other questions coming through, we will endeavour to get the panelists in to answer those fully. So the last one, probably Neil, for you, is what obligations have I in relation to providing personal guarantees on government-backed loans?
Yeah, so I mean, in terms of the government-backed loans, there is no guarantees up to 250 grand, is my understanding, and none of the guarantees for those loans will also take into account the private residence. So that's the criteria around it. Once you go above that level, lenders may, depending on the security package that they have and the risk that they see, they may ask for increased guarantees. I guess a couple of points on that, bear in mind that the government are guaranteeing 80% of that loan. So I guess it should only be 20%. Also, I think if I was talking to a bank, if I was a borrower, I would want the guarantee to be specific to that loan. And obviously guarantees are there for one of two reasons. One, because there's a higher risk of default, or two, because there's an absence of security, or sometimes both. So if you see any of those issues going to be dealt with in the short term, you may want to try and negotiate with the bank some sort of trigger that guarantee will reduce or be removed at the point at which the risk is reduced or removed. So yes, guarantees are always an issue, particularly on the back of the last financial crisis, but it's just care in making sure you're not exposed any more than you have to be.
Okay, and apologies, there's one question that's just came through here, which again is one that has been raised a number of cases, so I'll maybe put it out here if you don't mind. So it's one: can a company director with 50% or more share of multiple businesses apply for CBILS for multiple businesses, or is it limited to one CBILS loan for that director? Mark, are you happy to pick that one?
Yeah, no problem. And Robert may come in on this as well separately. So it's really at legal entity level. The one thing that might complicate that answer partly is if those companies are all involved in the same group structure with the topco and the parent company. And therefore, there's other things to consider, such as a combination of the turnover that might mean it takes it outside CBILS, for example. But as long as they're standalone entities, each can apply for it in its own right.
Yeah, and that would be my understanding as well, Mark. It's about that interrelationship, because they are all legal entities in their own right.
Okay, conscious of time.
Just want to say one thing. If it's actually a set of FAQs on the British Business Bank website, which might actually clarify that to some extent. Sorry.
Excellent. Yeah. Thanks very much, guys. Again, no questions dodged, which is great. And thank you very much for that. And I thought the session was really good today. The aim here is to try and get this very practical. A lot of the information stays on websites and FAQs, etc. This hopefully is demonstrating some of the practical elements that from a funder point of view and from the practitioner point of view as well. So thank you to everyone, and on behalf of Grant Thornton as well, thank to Shane for the opportunity to try and work with you guys again on this important program. Thank you very much, everyone. And just to highlight, the next webinar in this trilogy is on the 20th of October. So please look forward to talking through the next stage of this journey at that time. Thank you very much.
Thank you, Charlie. Thank you, guys.
Bye.